Welcome. My name is Philip Kennedy, and I'm the Vice Provost for Institute Public Programming. That's enough about me. I'm very pleased to introduce our distinguished guest. David Stasavage is Julius Silver Professor and Chair of the Wealth Family Department of Politics at NYU and affiliated faculty of NYU Abu Dhabi. He previously held positions at the LSE, the London School of Economics, and at Oxford University, although I don't know which college.
Not a very good one.
Not a very good one. Okay. Not Pembroke.
That's why I just say Oxford.
Okay. His work has spanned a number of different fields and currently focuses on two areas, to wit, development of state institutions over the long run and the politics of inequality. Professor Stasavage is the author of many articles and 3 books. His most recent book, which appeared in March, is entitled Taxing the Rich, A History of Fiscal Fairness in the United States and Europe. That's not an ironic title like that. It is published by Princeton University Press, forms the basis of tonight's talk, and was called a must-read by Thomas Piketty. He also has authored States of Credit, Size, Power, and the Development of European Polities, also published by Princeton University Press, and the 3rd book, Public Debt and the Birth of the Democratic State, France and Great Britain, 1688 to 1789, published by Cambridge University Press. He's a member of the American Academy of Arts and Sciences and received his PhD from Harvard University. Please join me in welcoming Professor Stasavage.
Okay, thank you very much, Philip. It's been a wonderful opportunity to spend the semester here at this great campus, and I'm happy to wind things up just before my departure with a public lecture on this topic that I've been working on for a number of years together with my co-author, Ken Sheevy. So if I asked people in the United Arab Emirates or in the USA, or probably in any country, should a tax system be fair, everyone would probably say, yes, the tax system should be fair. If I asked people in any of those countries, what is a fair tax system, or when is a tax system fair, we'd probably get a host of different responses. And that's what this talk is going to be about tonight, the different ways of interpreting fairness in taxation, and the ways in which those different interpretations of fairness feed through into the tax policies that governments actually choose. So if we think about tax debates today, if we think about what's happening in the United Arab Emirates, you have an environment where the UAE, along with other Gulf states, is considering the introduction of taxes. They're considering the introduction, it looks like a value-added tax is now certainly going to be happening. And questions have even been raised whether the UAE should adopt a personal income tax. Christine Lagarde, managing director of the IMF, suggested that Gulf countries should get ready for a personal income tax. I don't doubt that the general sentiment of the room here tonight is probably not that that's the best thing that one could possibly think of, but history may have lessons to tell us about whether it's going to happen or not. If we move to the United States of America, we have another important debate about taxation where inequality of income and probably inequality of wealth has risen dramatically in recent years. And there are questions that many people raised about why is it that those at the top of the income distribution are not taxed more heavily like they used to be in the 1950s or the 1960s. My objective in this talk is going to be, after I've laid out those 2 current debates in the UAE and the USA, to ask what history tells us about why governments implement progressive income taxes. And to do that, I'm going to use the evidence from the book that Ken Sheevy and I published about a month ago that Philip introduced to you. The goal of this book is not to take a stand and to say whether we should tax the rich more or whether we should tax the rich less. And that way it's quite different than most books that you will find written on this subject, which tend to be often quite polemical or at least take a clear position. Our goal is to remain neutral on the debate, but simply to look at what history tells us about when and why governments implement significant taxes on the rich relative to the rest of their population. And to do this for the book, we collected tax rates and information on tax debates in 20 countries, mostly in Europe and North America, over the last 2 centuries. So it was a large statistical enterprise. And if you think about the core puzzle from our book, it involves trying to answer or address what happened in this graph. This is a graph that shows across our 20 countries the average for the top marginal rate of income taxation and inheritance taxation from 1800 up until 2015. Several trends are clear. The 19th century is a period of very, very low taxation in terms of top income tax rates, top inheritance tax rates. In a lot of cases, countries simply didn't have an income tax or an inheritance tax, so we coded it as 0. And then sometime around the second decade of the 20th century, or more precisely around 1914, some governments started taxing those at the top much more heavily than had ever been done before, probably in the last 500 years of European history. And they did that by raising the top rate of income taxation as well as the top rate of inheritance taxation. And in the book, we have a host of measures showing why the top rate is an actual good proxy for generally how much the rich are taxed relative to the rest. The final development that you see in this graph is what's happened over the last 40 to 45 years or so. There's been a dramatic reduction in taxes on the rich over this period. And if you looked at this relative to the size of government, the reduction in taxes on the rich has become even more pronounced, because this is happening even in an environment where the size of government has been expanding, if you look at overall revenue to GDP across our 20 countries. And so what's happened in European countries, for example, is they've lowered top rates of income taxation at the same time that taxes such as VAT have become ever more important in the reduction of revenue. So when you look at the reduction in top income tax rates relative to this increase in the size of government, the move away from taxing the rich more than everybody else becomes even more pronounced. So that's the core puzzle that we seek to address in the book. We run through a number of different potential explanations, but the key that we emphasize is that ultimately how much governments tax the rich relative to everybody else depends upon these contested notions of tax fairness. And if we look over the last 2 centuries, there are 3 main arguments that have been made for or against taxing the rich more heavily than everybody else. The first is what we call equal treatment. If you go back in time over these centuries, you see there is a constant refrain from those opposed to progressive income taxation saying that no, everybody should pay the same rate of tax, just like everybody has one vote in a democracy. That's something that applies to democracies. It can apply to other countries to the extent that you think people should nonetheless be treated equally. In any environment where there's a norm of treating people equally, then it might be logical to have everybody pay the same rate. That's an argument that's out there. That's the argument, the main argument against taxing the rich more heavily than the rest. The main argument that we see in favor of it relies on the simple logic of ability to pay, and that simply says that for a rich person, $1,000 or 10,000 dirhams more in taxes is going to be much less of a sacrifice than it would be for someone who's poor, and therefore the rich should logically pay higher rates of tax than everybody else. That's the principal argument that we've seen most frequently for taxing the rich. But there's a second argument that we think is actually the most politically powerful argument in practice for taxing the rich, and this is what we call a compensatory argument. The logic of the compensatory argument says that the rich should be taxed when everybody else has been asked to sacrifice. So in other words, you're using 2 wrongs to make a right, as we would say in American English, or you're using one source of unfairness to compensate for another source of unfairness. And I'll give you some specific examples of exactly what I mean. So these are the 3 fairness arguments that we see empirically out there in the debates over the last 200 years. We're not saying we advocate any one of these in particular, we're just saying that's what's been out there in terms of the discussion. In what follows, I'm going to try to divide the talk up into 4 parts. I'm going to take you through income taxation, the early years up to 1914. Then we'll look at the effect of mass warfare and its effect on taxes on the rich. during the period from 1914 to 45. Then we'll look at the recent decline in taxes on the rich, more or less since 1980 or since the mid-1970s. And finally, I'll return to those questions I laid out at the beginning about current debates in the UAE and in the USA and see whether the conclusions of our book have anything to say about what's going on in those particular debates. Okay. If we take part one now, this is the income tax up until 1914. If you looked at the 19th century, income taxation was non-existent for most of the century, for most of our countries. The UK was an exception. The UK had established an income tax during the Napoleonic Wars. It was abolished, but then came back in 1842. During the second half of the 19th century, or more or less, probably after the revolutions of 1848, debates began to take place in a number of different countries about establishing an income tax with progressive rates, meaning that those who had more would pay a higher rate of tax than would others. And most supporters of progressive income taxation at this time suggested that it should be based on the simple logic of ability to pay that I already laid out in the previous slide. But there were also others who made a compensatory claim. And the compensatory claim they made was that since existing tax systems in these countries in the 19th century were based largely on indirect taxes, the predecessors to VAT, and we know that indirect taxes have a regressive incidence because those at the bottom spend a larger fraction of their income than those at the top, then they said it was necessary on compensatory grounds to have a progressive income tax so that the progressive income tax would counteract the regressive indirect taxes. This was the argument that Robert Peel, Great Britain's Prime Minister, made in 1842 when he argued successfully in favor of the reintroduction of the income tax in the UK. And as you'll see at the very end today, it might just be possible that this is an argument that will come into play in the United Arab Emirates after the introduction of value-added taxation. So that's the story for the beginning of the 19th century. Taking us up to the eve of the First World War, the end result by 1914 was that most countries had adopted income taxes and inheritance taxes too, but the average rates, the top rates on these were very, very low. So across our 20 countries, the average top income tax rate in 1914 was only 5.25%. Extremely low by modern standards, extremely low by what would be seen subsequently. A number of our 20 countries had no income tax at all, still, even in 1914. And the highest top marginal rate in any European country as late as 1914 was only 11%, and that was in Norway. So this is a key thing to recognize, is that while income taxes were fiercely debated in the 19th century and they were adopted in most of our countries, when they were initially adopted, they were adopted at rates were extremely low that wouldn't have had a big impact on the distribution of income. And the same could be shown in our book for top inheritance tax rates at the time as well, and the distribution of wealth. So that's the end of part one. That's the world as it looked up until the beginning of 1914. If things had continued, you might have expected an environment of income taxation that would be progressive, but where top rates would be extremely low by the standards that we've seen over the 20th century. So what happened? The key difference between pre-1914 and post-1914, of course, was that many of the countries in our sample of 20 entered a period of mass warfare. First with the First World War, then with the Second World War, where they mobilized a greater fraction of their population to fight than had ever been the case before. So these were expensive wars, but they were also wars in which there was more manpower mobilized than had ever been the case before. And this had a major effect on taxes on the rich. This is what happened if we break down between our 20 countries, looking at what happened in the mobilization countries, those that mobilized for World War I, and those that did not, and you see a really stark difference. In the mobilization countries, you see adopting on average top tax rates for income taxation that were unprecedented compared to anything that had been seen in the 19th century. Up to 50 or even 60% in some individual countries. The non-mobilization countries increased their top tax rates as well, but not by nearly as much. So there was a key demarcation here that happened as a result of war. And then the question we'd want to ask then is, well, why was the war having this effect? Was it just because it was expensive and you took the money where you could find it? Or was there some other explanation for why some governments were taking this step? Well, if we break down the war effect. This is now looking only at countries that mobilized for World War I, but distinguishing between those that were democracies with universal suffrage at the time they were participants in the war, and those that were not. The war effect is driven exclusively by those countries that had universal suffrage or near universal suffrage, the UK, France, the US, Canada, Australia, etc. It was not driven by the war participants who were not democratic. So that's a first indication that this war effect had something to do with politics. It wasn't just like everybody thought they would take the money where they could find it, because then we wouldn't expect democracies and non-democracies to be so different in this case. What we can suggest, and what we suggest in the book extensively, is that the reason why democracies moved to tax the rich so much more heavily during World War I is because of a new compensatory argument that came into play for taxing the rich. And this is an argument that was first voiced by the Trades Unions Congress in the UK in 1916. It became part of the Labour Party platform for the election of 1918. And it's an argument that was used throughout other countries as well, English-speaking countries, but in France as well. And so, as the TUC said at the time, as the manhood of the nation has been conscripted to resist foreign aggression, this Congress demands that such a proportion of the accumulated wealth of the country shall be immediately conscripted. The idea here came to be known as simply called the conscription of wealth. That if there was going to be a conscription of labor for the war effort, then fairness dictated that there should also be a compensating conscription of wealth. And this had a major effect on tax debates. How do we know this? Well, one of the things we did for the book was looked at what actually happened in the UK and other countries. We see this shift to a conscription of wealth in terms of what was being said. We see that even on the right, people started using the term conscription of wealth. And so The Economist, which is always a good sort of barometer for center-right received wisdom, which had previously fiercely opposed progressive income taxation, shifted during the war to say, well, there ought to be some sort of a conscription of income or wealth. This makes sense. It's only fair. What we did, a further thing we did for the book, was to look at tracking these compensatory arguments in the House of Commons. So what we did, we compared two periods of debates. Before World War I began, the debates about taxation during Lloyd George's People's Budget, as it was called, in 1909, and then what happened after World War I's outbreak in the UK House of Commons. And we looked at all the speeches during these two periods that referred to income taxation, progressive income taxation, for or against. And we looked then, we had people code the type of arguments being made. And the arguments against, as I emphasized previously, would usually focus on equal treatment to the extent they were focused on fairness, and they say, no, everybody should pay the same rate because we're in a democracy where everybody has one vote, and they'd make that analogy. Prior to the war, proponents of taxing the rich through progressive income taxation made their arguments almost exclusively through ability to pay, as you can see here. What happened afterwards? During the war itself, though, they shifted dramatically, and even some people who had previously opposed taxing the rich through progressive income taxation shifted to making a compensatory argument, a compensatory wartime argument that would say, no, we need to have high top rates of income taxation because this is going to be like a conscription of wealth, and that is going to compensate for the fact that we're already conscripting labor for the war effort. So this compensatory argument, we think, and we show in the book, was extremely powerful and was the principal reason why, during the middle of the 20th century, taxes on the rich rose to such high levels, and that would not have otherwise happened. Okay, so that's how we got to the world up to 1945, where we're in a world now where we're thinking about coming out of the Second World War. Countries like the US, like the UK, like France, have adopted very high rates of income taxation. In the case of the US and the UK, even exceeding 90% top statutory rate, which seems extraordinarily by today's standards. But we know that it didn't last forever. During the 50s and the 60s and into the 70s, there was a relative stasis in a lot of countries in terms of tax policy. But eventually, as I showed you from the graph at the outset, taxes on the rich did decline. And we want to ask why taxes on the rich did decline and why that's happened over the last 30 to 40 years. Well, a first reason you might think would be globalization. As countries have opened up their capital accounts so that money can flow more freely, as people themselves have begun to move more freely between countries, then it may have been the case that governments were forced to reduce taxes on the rich because otherwise they just wouldn't have been able to tax them at all. A new era of globalization where it's just impossible to tax the rich in a way that would have been the case prior to, say, 1945, or even the immediate years after 1945. So one thing that we can show from the book is we actually have good evidence across our 20 countries on when countries abolished their capital controls. And we also have evidence, of course, on when countries changed their top tax rates. So if it was the case that globalization was driving the move away from taxing the rich, then what we should see is that governments that moved to open their capital accounts or abolish capital controls earlier would have also been the ones to lower taxes on the rich at an earlier date during this period post-1945. In fact, that wasn't the case. There's actually no evidence in our data. We did the statistics exactly the way you should, and there's no evidence in our data to show that. So we're not saying that globalization is not going to be important going forward. We're not saying that in a country like the UAE, where you have a very mobile labor force, it's not relevant. But what we are saying is that if you want to think about why in the US, in Europe, elsewhere in North America, why taxes on the rich have come down so much over the last 30 to 40 years, then you can't just refer to globalization and think that's the answer. The evidence just isn't there. Second possibility. What about fears for economic growth? One idea that's frequently thrown about is that if you look at the Reagan and Thatcher revolutions in the UK and the US, which occurred almost simultaneously, that they were driven in part by the response to the slow economic growth of the 1970s, the crisis of the 1970s. So maybe there was a sense that people realized that high top tax rates on the rich were stifling economic growth and investment, making people not willing to work as long or as hard, making people less likely to invest. And so maybe it was the case that it was this slowdown in economic growth in the 1970s that helps explain why today we're in a world where governments have moved away from taxing the rich compared to what they used to. And it's just not the case. Again, we did the statistics the way you should think about this. And if you look and you see, well, we would expect maybe if this argument was correct, that countries that had larger growth crises, that had a larger growth slowdown during the 1970s should have probably been more likely to cut their top tax rates, and it's simply not the case. The evidence is just not there across the 20 countries that we look at. Okay, a third possibility, what about captured democracy? Maybe democracies became more susceptible to capture by the rich because of the role of money in political campaigns. And so it's simply a story of the rich being able to buy the process and not be taxed in the way that they used to do. And that is certainly something that people refer to all the time with respect to politics in the US today. If you think about politics in the US today, the US has more money in politics than any other country, I would suspect, in relative terms. And it's true that this is coincided more or less with a period where taxes on the rich have come down. What we say in the book, though, is that this captured democracy argument has to be made rather carefully. Think about what happened in the US's neighbor to the north, Canada, where there's far less money in political campaigns and where up until very recently campaigns were publicly financed. Well, the Canadians actually abolished their inheritance tax way back in the 1970s, and they've cut top income tax rates massively as well. And if you look at other countries, Sweden as well, other countries where we don't think of there being a big role for money in politics have nonetheless marched away from taxing the rich very heavily. So the captured democracy argument doesn't work, we think, or it doesn't work at least in its simple version, because you can't only refer to what's happening in the US in order to explain what is actually a much more global phenomenon. The move away from taxing the rich hasn't only happened in the United States, it's happened elsewhere as well, and therefore you need a broader global explanation for that. So finally, after we reject these three explanations for why taxes on the rich came down, what we suggest is that what happened simply was that by the time you get to the 1970s, if you're the Democratic Party in the US or the Labour Party in the UK, you no longer have access to the same wartime compensatory arguments that you would have had in 1945 or even in the 1950s. And so it wasn't so much that what changed was these new fears about globalization or growth or captured democracy. What happened simply is that we're getting further away from the wartime context. The wartime context and the environment in which these compensatory arguments could be made had pushed top tax rates up, and eventually it was going to be the case that in a period of peace, you would move back, or in a period of more limited war at least, you would move back to lower top tax rates on the rich. And we can see this if you looked in the sort of party manifestos from Labor in the 70s or the 80s, or the Democratic Party platform in the US from this same period. Politicians who were previously had been making compensatory arguments were pushed into the position of having to make arguments that simply said, well, we need to tax the rich because it's fair, but they weren't saying why it was fair. They didn't have a good argument for why it was fair. And so we think that changing circumstances meant that what previously had been possible as a fairness-based argument was no longer possible. Therefore, we get a decline in taxes on the rich. How can we show this? Well, one interesting way to track these compensatory arguments over time is to look at Google's Ngrams tool. So the Ngrams tool, you can put any phrase in almost any, well, not any language, but a whole bunch of languages, and look at the frequency of that phrase in the Google Books database, which is just basically everything that Google has managed to vacuum up in the particular language. And what we did was we looked at this Ngrams frequency for the phrase equality of sacrifice. Equality of sacrifice in British English was a term first coined by John Stuart Mill that had originally meant ability to pay. It was originally designed to say that taxation should be based on ability to pay, but during the war period, equality of sacrifice took on a new meaning. It meant equality of sacrifice in terms of the war effort. What's interesting is if you look at the frequency of the usage of this term in the English language, it spikes dramatically during the two world wars, and then it drops down equally dramatically afterwards. Just as if what I was just saying on the previous slide, these compensatory arguments had been powerful and could be made in an environment of wartime, but were no longer made after that point. And in this exercise, the two lower lines here show that you see a roughly similar pattern in terms of the phrase equality of sacrifice being used if you look at all debates in the UK Parliament, or if you look at debates in the US Congress. So there's some sort of systematic evidence to say that these compensatory arguments that had been present were suddenly no longer present. And so those who favored taxing the rich were devoid of the principal argument with which they'd had such great success. If we look at the US situation today, another thing we did for the book, and this is carrying things up to today, is we asked a series of nationally representative sample of 2,000 US citizens, adult citizens, a whole host of questions about what tax rate they preferred, what different tax schedules they preferred for income, and then we asked them what their preferred was in the end, and we plotted this using one of these type of plots, and what you can see is that if you look at the tax schedule based on from less than $10,000 a year income to 10 to 35, 35 to 85, 85 to 175, and so on, these kink points correspond to the current U.S. tax system, the income tax, where the brackets are. And the top marginal tax rate in the U.S. for the greater than $375,000 a year bracket is now 39.6%. If we look at the plot here, what you can see with the two boxes, or about 50% of the data, the median response is right at 30%. So what it's suggesting here is some people would like a slightly lower tax rate in the US today than what we have. Some people would like a slightly higher. But there's not much evidence to say that the American public would like something dramatically different than the current tax schedule. The current tax schedule looks a lot like the average of these responses here. So what I'd suggest from that is that we're now in an era where wartime compensatory arguments are no longer practical. And so this is an illustration of that fact that if you think of what American voters actually want, there's not tremendous support for going back to, or hardly any support for going back to the extremely high tax rates that we saw in the middle of the 20th century. Okay, part 4 now. let's come back to those debates in the UAE and in the USA, and let's think about what these historical lessons might have to say about them. And I'll start off with the USA. So what our research suggests more generally is that whether you're the UAE, the US, or any other country, we're in an era where we're unlikely to have mass wars. We're in an era where there's more likely to be mechanized wars that may be expensive, but not mass mobilization of labor. So wartime compensatory arguments of old are no longer going to apply. And that means we're unlikely to have the high top tax rates of the past. But even so, I'm going to suggest ways in which fairness arguments are still very important for the politics of taxation and for thinking about what kind of tax policies will get proposed and what kind of tax policies will get chosen. So let's think about the US. There's little consensus in the US, among candidates at least, in terms of where the top income tax rate should be. I just showed you the survey that said that there was actually a fair degree of consensus among the American population for where the top tax rate should be. But there's little agreement. This is including both candidates who have recently departed the battlefield and candidates who are still in. If we go back to the current top income tax rate in the US, recall, it's 39.6%. Bernie Sanders, who is still sticking in there, would like to raise the top tax rate in the US to 54.2%. So that's a pretty significant increase. If you come back to the survey I just showed you, if you think about that, 54.2% is actually pretty far up there in terms of the data. There's not actually all that many people who are favorable to that. They may like Sanders for other reasons, but if you actually ask him just about taxation, in a nationally representative sample, there's not a heck of a lot of support. What about Hillary Clinton? Clinton's, as you would expect, much more moderate, is proposing increasing the top tax rate to 43.6%. So a small increase of about 4 points. Donald Trump, to the extent that you believe what he says that he will cut the top tax rate to 25%. And Ted Cruz, being, as he was, always very audacious but unsuccessful, suggested that we should cut the top tax rate to only 10% in the US and implement something to make up for the lost revenue that sounded a lot like a VAT, but that he wasn't going to call it VAT because of VAT as a European idea, and that's bad. So what you see then is the candidates are or have been all over the place in terms of the top tax rates they proposed. It seems like Cruz and Sanders are probably out of what most U.S. voters in a general election would want. Clinton's pretty close to it. Trump himself is quite low compared to what most people would want. As I said already, our survey shows that there's not a lot of support in the U.S. for going to a top rate that would be dramatically different from what we see today. So this seems to be mostly within the two political parties. There's disagreement, but that disagreement is not seen to the same extent in the U.S. electorate. Okay, so if you just looked at this, you might say, well, like U.S. politics today, we're not going to get anywhere because none of the candidates agree and there's not going to be much support for big change. So sorry, that's it. So there's little U.S. consensus in favor of large rate increases. What about other things, though? One of the features of the U.S. tax system is that if you look at those at the top, then the effective rate, the amount of tax they actually pay, often is quite a bit lower than what you might expect given the statutory rate. So the statutory marginal rate is just the rate that's going to be applying above that $375,000 in theory. The effective rate of tax is what actually happens if you take their adjusted gross income from their 1040, and that is the denominator, and on top of that you put the tax they actually pay. It's sometimes called the average rate of tax as well. In the U.S., once you get higher within the top 1% of earners, earning more than about $700,000 to $800,000 a year and above, progressively on average, the higher you get within that group, the lower your effective rate of tax today. So this is due in part to differential treatment of capital gains. It also is due to options to classify income as capital gains. What it means then is that at a certain point in the U.S. tax system, for most of it, the wealthier you are, the richer you are, the higher your level of income, the higher your level of tax. But at a certain point, the tax schedule actually slopes downward in terms of the effective rate. And so, to some extent, we could say the rich are actually paying less than everybody else. This is what motivated Warren Buffett to propose the Buffett rule, where he said he should at least be paying the same average rate of tax as his secretary, and that's been incorporated in Hillary Clinton's campaign tax proposals. So what's interesting about this is that both on the left and the right, you've seen more consensus in terms of doing away with features of the U.S. tax system that mean that the rich are paying actually less than everybody else. So we have this provision called the carried interest provision sometimes, which allows people working for hedge funds or in private equity, actually more private equity than hedge funds, opportunities to classify what we might think of income as capital gains, long-term capital gains, paying a lower rate of tax than would be otherwise be the case. Hillary Clinton's proposed doing away with this carried interest provision. Interestingly, Donald Trump has proposed the same thing as well. And you could say it's demagogic, he's not going to do it, and so on, but he's smart. One thing you could say about Trump is he's not stupid, and he's probably sensing that there is a fairness argument there in favor of doing away with provisions that mean that the rich are actually paying less than everybody else. So the bottom line is for the U.S. is that there may not be much support for having the rich pay much more than everybody else today, but there's certainly going to be support for having the rich pay at least the same rate as everybody else. And so this is something that whether you're a partisan of equal treatment or whether you're a partisan of ability to pay, you should agree on this. Equal treatment and ability to pay, people will disagree on whether the rich should pay a higher rate than everybody else, but they should certainly both agree on the principle that the rich should at least pay the same as everybody else. So we expect, and we talk about this in the book, that U.S. tax debates going forward are probably going to focus a lot more on doing away with these privileges like the carried interest provision rather than on bumping up the top statutory rate. So that's what we expect for the U.S. What about the United Arab Emirates? So, as I said at the beginning, the UAE will soon have a value-added tax in place. That's going to come in for other Gulf countries as well. Christine Lagarde, when she was here in February for the Arab Fiscal Forum, made a statement saying VAT was a good thing, but that Gulf governments should also get prepared for thinking about income taxation and maybe corporate income taxation and personal income taxation. And there's also another IMF report, it's not an official report, it's more of a working discussion paper, that says that if you think about Gulf countries, that introducing a progressive income tax would be fair. The thing that's interesting about the IMF report, it doesn't say anything about why it would be fair or how it would be fair. It just sort of says, oh, it would be fair. And so, well, what does our book tell us about this current situation in the UAE? We don't have a crystal ball. We can't tell for certain whether everybody in the room is going to be paying income tax in a few years' time. But we can turn back to history and think about what's going to happen. Well, you're not going to have the mass warfare context that drove really high top rates in the US and Europe. That was a US and Europe specific event, so that's probably not going to happen. So what we might do better to do in thinking about the UAE context is a look back to 19th century European history. Remember, I said that in 19th century Europe, Robert Peel, Great Britain's prime minister in the 1840s, and people in other countries as well, argued for progressive income taxation based on the idea that that would compensate for regressive indirect taxes being the ancestors of today's VAT. This is a peacetime example of a compensatory argument, and it had some power at the time. It probably had some power in terms of getting European governments in the 19th century to adopt progressive income taxes. Although you'll be happy to learn, it got them to adopt progressive income taxes with very low top rates, only top rates of about 3 or 4% or something like that. So we're not saying that because there's a VAT in the UAE, suddenly there would be a top personal income tax rate of 30% or something like that. The VAT rate is going to be very low here, on the order of 3%. So it's probably logical, I would expect, that if the argument was made, the fairness argument could only be justifying a very low top rate of income taxation in the UAE, but it might justify one. And so we do think, and we wrote about this in the National today, that an argument could appear, you'd have to think about who would make that argument and why they'd make it, but that based on fairness grounds, that because VAT has a regressive incidence, that income taxation that was slightly progressive might be introduced in order to say that two wrongs could make a right, or that one source of unfairness was corrected by another source of unfairness. So that's what we expect might happen in the UAE. Of course, it would be silly to expect that the UAE is simply going to repeat the history that we saw in Europe, but to the extent that history has lessons, it may be the case that once you adopt a VAT, there are pressures that emerge in order to adopt progressive income taxation as well. Okay, concluding, final slide here. So what can we conclude then about the question I asked at the very beginning about when taxes are fair? Well, one thing I've shown you is that, first of all, tax fairness matters because citizens care about it. We're not saying in this book that everybody should be nice and fair or fairness is important. We're saying that it's important in the political arena because people actually tend to be motivated by these notions of fairness when they think about what political parties they support and when political parties think about what type of tax plan that they're going to propose. So fairness matters for politics. The second thing is that tax fairness itself is contested because there's really no set definition. This goes to the heart of the word. If you look at the definition of the word fair in English, there's no set definition. It doesn't provide you with an automatic roadmap for thinking about what a tax system should be like. So fairness is a contested notion in taxation. There's no set definition. And we've offered you these three main arguments that we see in history of equal treatment, everybody pays the same rate, ability to pay, the rich should pay more because they have more, and compensatory, the rich should pay more because everybody else was asked to sacrifice in some other manner. We think that historically, compensatory fairness arguments tend to be those that are the most politically powerful. And so if you look at the US, the UAE, or other countries going forward, taxation of the rich relative to the rest of the population will depend largely upon what sort of compensatory arguments exist and whether new conditions allow for new compensatory arguments to emerge or not. And I'll stop there. Thank you.
So just, sorry to repeat that, a question about how far your argument travels and which pieces of it we should see as relevant here in the UAE. So one question is, when you're thinking about mass mobilization, how do we see this argument play out in Asia? Do you look at any, Japan, do you have that as a case, for example?
Japan, it works in Japan as well. Yes, and Korea as well.
Okay.
Yes,
okay.
yes.
And for the sense that, you see a big divergence between democracies and autocracies. So do you see any equivalent argument about fairness that doesn't use the sense of equal pay or compensatory fairness that kind of speaks to people in autocracies as something about, kind of what the government, what we expect the state to do for us? Or is there some other version of fairness?
Much less so during World War I. World War II, actually, oddly enough, some of the people that ostensibly, in terms of propaganda, were most interested in showing the fairness of their tax system was the Nazi Party. Because there was a sense that they had not been successful in World War I in mobilizing everybody. And so you see arguments of the sort of trying to show that the tax system is fair in a wartime context. Same things happens in Japan in World War II, actually, as well. And so I think, to the extent that an authoritarian government still needs to obtain tacit support from its population, then the argument could. But we do think it's likely to be a stronger effect in democracies, just for the reasons I laid out.
And so final question on that is, if you look at post-colonial democracies, so they then, by definition, generally didn't mobilize for World War II.
Or in some cases very heavily mobilized, like India,
but
right?
It wasn't their choice in the process necessarily.
That's right, yeah.
So in those cases, do you see a bump? Do you ever see those countries reaching high levels of taxation on the rich, or is that basically
Well, they do in terms of the statutory rates that are on the books, but there you get into problems of administrative capacity to actually collect the taxes, which is another key element that needs to be there.
Yeah. Okay, thanks.
Thank you for taking time to do this. I want to ask, in the case of a progressive income tax, very often we see a sort of apprehensive attitude that people have for moving into higher tax brackets. So how do you think that affects productivity and economic growth in general?
Well, this has not been what we've done. There's been a lot of analyses trying to show that higher income tax rates are bad for growth. And it actually turns out to be a very difficult thing. There are difficult econometric issues. I wouldn't say that certainly if you think about it, I referred, the UK and the US, after coming out of World War II, had a top statutory rate of greater than 90%. That's a rate which was obviously set not with revenue generation or growth possibilities in mind. That's a rate at which you're basically giving people an incentive not to work. That's almost functioning a bit like a cap on taxation. But coming back to lower rates than that, that would still be high compared to what we have today. I don't think one can't simply reflexively refer to the growth evidence. But in any case, our goal in the book, precisely because we're not economists, we're political scientists, we try to ask what governments do and why they do it, whereas the economists would say, what should governments do? Our goal is to see whether those arguments about growth have actually swayed policy decisions over time. And what we try to show in the book, what's really interesting, actually, we didn't realize this till we got into it. If you look at these 200 years of debate, those sort of growth arguments like the sort of you just made have been made all the time. They've been made constantly for the last 200 years. And it's not saying that they're not valid, but it's hard to explain the huge changes in tax rates given that those arguments have been present all the time. It's not like they were suddenly invented in the 1970s.
But is there a correlation
between what?
between growth and the change in the kind of physical policies applied?
No.
No.
No. Yeah, no.
So that may answer the question.
No. Well, yeah, but I don't. I mean, there are economists in the room here, so I wouldn't say that I'm going to be. Economists, and rightly so, wouldn't be satisfied with us just running a regression with our top statutory rates and growth rates and saying, oh, we've proved that top tax rates when they're high aren't bad for growth. I think that the evidence is not in our data to show that they are, but I'm not going to venture too far out on a limb on that one, I think is what I'd say.
I'd be interested to hear what you think about the correlation of corporate tax or corporations tax, and if you observe similar things to income tax, and what you think the implications for the UAE would be in regards to corporation tax, especially given we've seen what's happened with the Googles and the Apples of the world and their effective tax rate being significantly lower than what they should be.
No, so one of the things that we do say, the strongest evidence for globalization and the effect of tax competition is on corporate income taxation. Right? We didn't collect, it would be nice to have a data set on top corporate tax rates for 20 countries across 200 years. Maybe that'll be another book. But the existing evidence out there is much more clear. So what we try to, in the one chapter of the book where we look at this, we draw a distinction between the effect of tax competition and globalization on corporate income taxation versus personal income taxation, because to the extent that you think it's a lot easier for a corporation to move their sort of legal residence than it is for an individual to move their legal residence, at least if you're looking at larger countries like the US and the UK where you don't have extremely mobile populations, then we do see that effect for corporate taxation. Yeah.
Just a quick question, and then I'll pass it to you. I have a question about social history, because I noted one of the graphs when you started to talk about the fact that the World War I was the cause of higher taxation. I noticed that the black line, the uninterrupted black line, kept going up after the war. So presumably, what the explanation of that, I don't know. Presumably it's to pay debt or incurred by the war.
That's precisely it. There are some countries that sort of take the bull by the horns and during the war say, okay, we've got to put up top tax rates. That's something that happens in the the UK and in the US. In France, in contrast, what happens is they're operating during the war on borrowing and hoping that the Germans will be forced to pay. And then they get to the point where they're after the war, they have debt, and something needs to be done, and so the debates get postponed. So that's why they appear to be going up. They are going up after the war, but they're going up after the war because a lot in some of the countries, the debate about what should happen gets postponed until after peace.
And I was wondering, related to that, if because I don't know if you've seen Downton Abbey, but Julian Fellowes, the person who wrote that script, actually he'd written Gosford Park before, and both are actually concerned with the fall, really the end, the swan song of the British aristocracy. And I'm wondering if I mean, this is social history, but if you think that the end of the aristocracy in England had anything to do with taxes as well as all the other things.
Well, yeah, I mean, I think it's remember I was saying before that there's no evidence on our data that past changes in inequality prompt governments to change the tax rate. There is evidence in our data, quite strong evidence, that increased inheritance taxation appears to be associated with lower inequality in wealth down the road. And so there are a lot of other people who have been working on this, and I mean, the first good work of it was actually done as early as 1930 in the UK, suggesting that these wartime top tax rates had actually had a pretty significant impact on the UK income distribution and on the wealth distribution as well. So I think there's actually something to that, to that swan song interpretation, very much so.
So my first question has already been answered or half answered. I just was wondering about this long delay from 1945 to 1980.
Oh, I thought I was going to get away without having to answer that.
Yeah, I mean, but we're almost basically, I mean, but it seems like quite a long delay. I mean, 35 years. So, well, it's kind of interesting how sticky, or I don't know if you want to call it path dependency or whatever, how it was kind of locked into the political system. That's quite interesting. But the second question is, I think, more on my mind. Do you think there's a move from this compensatory logic to a logic of fairness is equality, so that there's a growing consensus that societies that are more equal in terms of income or wealth distribution, these societies are actually, this produces good outcomes in terms of social outcomes, economic outcomes like lower crimes, less social conflict, and so on. And this even, I think there was recently this World Bank study that argued it's actually good to have progressive, tax rates because it produces more equal societies. This debate has shifted a bit from just everybody should sacrifice to actually we are interested in that outcome.
Yeah. No, I mean, I think that it's very plausible, and a lot of people certainly think that, and that the strength of that norm is going to vary from society to society, but there's not much evidence on our data to suggest that that's driving things, because we don't see inequality driving the top tax. I think the way that we would put it is what people are probably most, or certainly most concerned about above all, they're not just concerned about inequality per se, they're concerned about how inequality is generated, right? And whether the process by which it's generated is unfair. And what we're saying through the compensatory argument is people are really concerned about inequality that's generated because the state itself has treated people unequally or unfairly to begin with.